objectives of this class or this time will be to gain an initial understanding of the architecture and functions of a global financial system and infrastructure, to gain an initial understanding of how blockchain, cryptocurrency-based systems could perform similar functions. And in particular, we're going to focus on the central bank functions and cryptocurrency equivalents, understand how central banks are potentially approaching central bank digital currencies or CBDCs, and what design/architecture trade-offs exist. We're going to distinguish the different types of settlement systems and how they relate to cryptocurrency blockchain-based settlement. We're also going to gain an initial understanding of the mapping of key cryptocurrency industry segments to the traditional finance service industry. So we're going to map out the new financial industry and the legacy financial industry. And we're going to work to distinguish between services provided natively on the blockchain versus by firms in the cryptocurrency financial services industry. So we're going to get an idea of the maturity of the cryptocurrency financial field. It's going to be an interesting ride. For one, we're going to go over central bank functions, central bank versus cryptocurrencies, central bank digital currencies or CBDCs. Get familiar with that. CBDC. Settlement systems, settlements and digital currencies, financial services, cryptocurrency financial services. And then I want to close out. Start with central bank functions. So central banks, they're responsible for the effectiveness of the monetary and the banking system, and they're financial entities that are established in countries and currency zones to define and support the monetary system of their nation. Their typical responsibilities include creating the rules and regulations under which national banks should function. They monitor the stability of inflation rates, of the price of money, and regulation of the debit and credit framework of the nation, and control the money issuance and supply. And they can also act as the lender of last resort for banks or other eligible institutions. In other words, they can provide liquidity to commercial banks in times of extraordinary circumstances. So what public cryptocurrencies actually do is they provide a very much narrower set of central bank services. For instance, like regulating the bank sector, ensuring the state of financial for the country they operate, blah, blah, blah. Let's see, we're going to dive into central banks versus cryptocurrencies. So some people believe that cryptocurrencies are algorithmic central banks, which I also believe is true. There's a large segment of the cryptocurrency community that believes certain public cryptocurrencies will supplement or replace national sovereign currencies. So this segment views the currency aspect of cryptocurrency as being very important. We're looking at the monetary aspect here. And conversely, many central banks over the years, they have a negative outlook on cryptocurrencies because they're analyzing them in the framework of a monetary system and not a technological system. For the purpose of this section, we're going to be looking at the analogies between public cryptocurrencies and central banks. We're going to reference Bitcoin mostly because Bitcoin is the most popular and the most well known. So, for instance, on one side we have the set of functions that are carried out by banks, and the other set of functions that are carried out by cryptocurrencies. The general functions are a monetary stability function, whereas with a central bank, it would be called a monetary policy. With cryptocurrency, it's a monetary policy, but it's fixed at inception, at its creation, and it can be changed by the majority of the miners, the people who are actually working to put the coin out there through hashing using their nodes. So in the case of Bitcoin is mildly inflationary, and over the rate of time, the amount drops rapidly, eventually going to zero. So the amount of Bitcoin in circulation goes up over time, but it's at a fixed amount. And the amount that will be put out over time goes down until eventually it's zero. Financial stability and regulatory functions is another general function. So for a central bank, they have exchange rate policy, prudential policies, supervision and oversight. Cryptocurrencies don't have any of those. Generally, you're in charge of your own money. You have to do all the oversight and supervision. And there's really no policies in place for you, except for the ones placed upon yourself. Policy operation functions such as foreign exchange intervention, foreign exchange reserves, and having the ability to be a lender of last resort. No, there's none of that for a cryptocurrency. You are in charge of every piece of that. So financial infrastructure and provision functions, currency provision, banking, account management services, payment system, interbank, settlement system of central bank money, other settlement systems and registry provision, all things done by central banks. So sometimes, yes, there is a currency provision for cryptocurrencies, and that is through block rewards. So for mining, you would receive rewards in the form of that cryptocurrency. There is no management services for you yet. Of course, there will be systems that are put in place to help you manage the funds. Payment systems, yes, of course. So cryptocurrencies have a built-in payment system, and from one point of view, it merges a variety of traditional payment and settlement systems. Really cool stuff. Cryptocurrencies are in a class of their own, but it does not have a registry provision. Let's dive into central bank digital currency. Jose, CBDC. CBDC. So in January of 2020, the Bank of International Settlement stated that around 10% of the central banks surveyed are likely to issue a CBDC for the general public in the short term, representing 20% of the world's population. There are a lot of large countries who are looking to get involved with cryptocurrencies and having their own currencies, having their own central bank have a currency to issue to the people rather than a currency that is owned by no one floating around and giving people monetary power. Government entities and central systems like to have the control over the direction of their economy and the people. So having a currency that is not controlled by them in circulation and generating value, monetary value amongst its people, and helping check their economy is not something they would probably be interested in. Central banks are continuing to research CBDCs, yet there's no evidence of a widespread or general move to expand this research into experimentation and pilot arrangements. If I'm not mistaken, I believe China is working to put out their own coin, or is it Japan? It's one or the other. They're working to put out their own central bank coin, central bank digital currency, because, of course, as I just said, they want to have that control, but they see it as useful in being able to track individuals. And if I remember, I read an article correctly, in the country, you would be able to open up a government-based wallet, and you would be able to use the wallet to accrue the coins that were sent out from the government, make purchases and transactions. So a few central banks with sufficient motivation are proceeding for the pilot various designs. Motivation for the research behind these continues to be diverse. So cash use is the key to driving many central bank plans with emerging market economies, EMEs, central banks aiming to reduce reliance on cash, and advanced economies acting to preempt any issues that might be faced by the general public in accessing central bank money. So some people in these emerging market economies aren't able to access money from their banks like you and I have the ability to, such as simply from the internet or just being able to drive there, but they still have a central bank there and they need to access their money. So in order to make things a lot easier, they're gonna put a central bank digital currency in play and give these individuals the ability to access it, whether it be from a phone, tapping into the internet, or some other system they have set up, so that they're able to not only use cryptocurrencies but access the funds inside of the central bank, deposit funds, withdraw funds, etc. And it all stays digital, so it makes it a lot easier versus having to carry around your cash and keep up with it. Whereas everything is tapped into an algorithmic system, and you're able to just scroll through your phone and access it. Finally, collaboration on understanding the impact of private digital tokens may also need to intensify. Of course, over the course of the coin actually becoming sustainable for any economy to use, more research has to be done. This is cutting edge technology. There are a lot of people out there. There are actually countries like, there's a country, I think it's South Africa, if I'm not mistaken. I think they have the Sango coin. They're adopting their own cryptocurrency. Actually, let me Google that. I don't want to lead you astray. Sango coin is the coin of the Central African Republic. Yes. And you can actually obtain a citizenship there by owning Sango coins, and it has to be in the amount of $60,000. You lock it up and you keep it there for 5 years, and you obtain a citizenship to Central African Republic. Their coin is the Sango coin. I believe I'm saying that right. Yada yada. It's a bunch of great research they have right here. Metrics are beautiful. If anyone needs access to the documents that I'm reviewing, please contact me. I will send it your way. It lets you know how a lot of these central bank digital currency systems would be set up, the architecture and infrastructure. Of course, these are important things to know. So the fundamental difference between a fiat-backed stablecoin, remember fiat is a currency that is not backed by a commodity or good. And a stablecoin is a coin that is pegged to a fiat currency or a commodity or good. So for instance, a stablecoin generally retains the value of like $1 if it's pegged to the US dollar. And central bank digital currencies, we're speaking about right now. So the key fundamental difference is the issuer and the spectrum of the issuer. So the issuer may be a country's central bank, an organization, or anyone else. With a central bank digital currency who also is the issuer of the fiat currency, there will always be a stable value of one central bank digital currency with a one fiat currency. So if the bank is the one lending, is the one that is holding the supply of the money that will be backing the coin, then it's always going to have that money in reserve. Whereas in a decentralized system where the money is basically put in a pool, it's algorithmically set up to always maintain that one-of-one value, but it's not always guaranteed. But so far, the systems that are in place currently, like for USDC, US dollar coin, those are working very well. If I'm not mistaken, a couple of months ago, there was one that did crash because of the infrastructure it was set up on was not proper. But ever since then, like, people double down on the work that they do to make sure that the systems they set up are operating at an optimal level. So with anyone other than the central bank issued stablecoins, the fact is that they are not the issuers of the fiat currency. These decentralized systems aren't issuing the fiat. They just have enough fiat to keep the stablecoin at a 1-to-1 ratio. So stablecoins are operating in an environment actively hostile and maintaining the peg to the fiat currency, with markets trying to take advantage of the slightest price fluctuations. So people are trying to either short or long that dollar or that stablecoin in order to benefit from the difference. So it is actually very interesting that they're able to still maintain that dollar peg, which is why I think it's really important that they maintain the algorithmic system, because they don't, people are going to wreck it and they're going to make a ton of money in the process legally. So the fundamental difference between, yes, I'm sure. So potential reason is it may not in reality have the fiat currency claim, thus not being 100% fiat backed, contractual obligations, delays in delivery, etc., leading for the stablecoin trade lower. There has been an instance where there was, I don't remember the protocol, but there was a lot of money in circulation for a specific stablecoin, and they were wondering where was the money that was actually backing this coin. There was very little proof that this coin was actually being backed by the money that they said it was. The approach is be institutionally credible, trust, and over-collateralize frequent audits. things that could actually happen in order to reassure that a stablecoin is holding the value that it is supposed to be holding. Central bank digital currency is the only true stablecoin, since they are the issuer of the fiat currency and the ones issuing the stablecoin. They will always have that reserve in order to keep that at a 1-1 peg. Anything else is some deviation away from a perfect stablecoin. A CBDC is fully collateralized, fully audited, highly professional, and its issuer is trustworthy. These are ran by the central banks of the country in question. In a central bank digital currency world, how would one type of central bank digital currency trade with another type? For an example, and a virtual dollar being traded with a virtual euro, and how would those protocols communicate with each other? So it's dependent upon the design decision of the central bank, and a couple of different types could exist. They use a centralized exchange. If you're not familiar with exchange, a central exchange for cryptocurrencies, check out Coinbase. It's one of the biggest. Or a liquidity provider who holds both coins and trades one digital currency for another. A liquidity provider is where individuals pool money into a system, and they'll have, let's say, X amount, 2 billion worth of US dollar, they have 2 billion worth of euros, and they're able to, as people put money in and take money out, they're able to exchange that, and they maintain a pool so that that money can always be traded equally. Use a decentralized exchange and trade Bitcoin on Ethereum exchange. Wrap Bitcoin. There are multiple versions of Bitcoin. You can wrap Bitcoin and send it cross-chain to another platform. So say you have Bitcoin and you need to send it to Ethereum in order to send it to another chain. You could wrap that Bitcoin and send it. Otherwise, only Bitcoin can be traded on the Bitcoin network, such as only Ethereum can be traded on the Ethereum network. You have to go through special protocols in order to send cryptocurrency cross-platform or cross-network. So central bank digital currencies may extend existing practices to a digital format. We're in a digital world right now. It only makes sense we have digital money to accommodate it. So a central bank digital currency is issued and backed by the central bank, of course. Holders of the central bank digital currency have a claim against the central bank. There's no credit or liquidity risk. They can help central banks retain sovereignty over monetary policy in a tokenized asset market. They may provide opportunities for new regulatory monitoring and enforcement tools. You can open up a ton of jobs. May lead to cheaper cross-border remittances, reducing charges and waiting times, even though that's still questionable because with cryptocurrencies we have in place now, we really don't need a central bank digital currency. You can send $1,000 to Guatemala right now in the blink of an eye if you chose to. It's really just dependent upon you. As long as they have a wallet, you have a wallet, you can send money to and fro as much as you want any time of the day without any intermediaries. You don't have to have a middleman to approve where you send that money. It's just from the tap of a finger in a couple of seconds. And it could be a replacement for physical cash. At the moment, we have more digital cash in circulation than we do physical cash. There's more digital cash than there is physical cash. I think it's a whopping majority of the money in circulation is digital. And this could be an opportunity to rethink relationship between central banks, commercial banks, and depositors. So it's an interesting system. And speaking of systems, we're going to get into settlement systems. So payment systems. A payment system refers to the complete set of instruments, intermediaries, rules, procedures, processes, and interbank fund transfer systems which facilitate the circulation of money in a country or currency area. A payment system could consist of 3 elements: payment instruments, processing, which includes clearing, and a way of settlement. Scenario 1, 2 accounts in the same bank. It's the simplest one. Bob wants to send $100 to Lucy, and they're both customers of Chase Bank. So Chase will debit Bob's account $100, aka they will say that they owe Bob $100 less, and they will credit Lucy's account $100, aka they will say they owe Lucy $100 more. The whole transaction is internal to Chase, meaning that it can occur using Chase's internal systems. There's no credit, counterparty risk for Chase, and it does not impact their liquidity in any way because they're netting against themselves. It's an intermediary exchange between themselves. So there's no money lost in the process. It's just digital transfer between accounting. Scenario 2, corresponding banks. So let's assume that Bob and Lucy are at different banks. Bob is at Chase, and he wants to send $100 to Lucy, who's at Citibank. So Citibank and Chase have a corresponding relationship, meaning they maintain accounts with each other. So Chase can debit Bob's one account $100, meaning they will owe Bob $100 less. They can credit Citibank's account $100, meaning they will owe Citibank $100 more. So Chase nets out. So that means Citibank will credit Lucy's account $100, meaning they will owe Lucy $100 more, and it will net out against the $100 credit they received at Chase. So that system is effective also, but it has weaknesses. It's not practical to every bank to have a corresponding relationship with every other bank. They have their differences in the banking world. Some banks want to eat the other banks. It's just how it works as business. And the banks are exposed to credit risk, counterparty risk with each other. Scenario 3, settlement systems. So it's the most generic system. Let's say Bob, who's at Chase, wants to send $100 to Lucy, who's at Citibank. So Citibank and Chase use the same settlement system, and they have accounts at the same system. So Chase can debit Bob's account $100. They owe Bob $100, and the settlement system debits Chase settlement system account $100, and it credits Citibank settlement system $100. So Citibank credits Lucy $100. It never leaves the system. So the settlement system can be private. It can be a private company, or in the case of the ultimate settlement systems, the central bank of the country. An example. Settling with the central bank money has more advantages to system users, so there's no counterparty or credit risk. Usually the provision of credit overdraft is needed, and usually it's low cost. There are 3 types of settlement systems. There's the gross settlement system, where each transaction process is processed as it happens. So it's not bundled or netted in batches. It reduces intraday credit risk and increases liquidity needs in case you need to fund each transaction at a time, and subsequently cost of liquidity, more reserves or interest charges. There's the net settlement system, meaning transactions netted out at specific times each day, usually at the end of the day. So only the net amount is settled. It reduces liquidity needs as the net amount has to be available from a liquidity perspective, and it increases intraday credit risk. And then there's the hybrid systems. Systems that are effectively near real-time systems, but look for opportunities to reduce liquidity needs as such. So the netting of queued orders, and the prioritization of orders, and delaying orders above certain liquidity levels are a risk that come with this, and prioritization of orders, delaying orders above certain liquidity limits. These are just part of the risks that come with actually having to use a hybrid system as far as the settlement system goes, which is why they choose to use that system, but it's still very generic. The one probably the most widely distributed banks use. There are 12 Federal Reserve banks. Boom, we have a beautiful map here. Remember, if you need any of these documents, please contact Mom. I'll send it your way. Great stuff here. There's a Federal Reserve Bank in Atlanta. There's 6 in ATL. There's some in Boston, in Chicago, Cleveland, Dallas, Kansas City, Minneapolis, New York, Philadelphia, Richmond, San Francisco, and St. Louis. Yes, sir, indeed. So, Fedwire, key policy issues. Fedwire is required to charge market rates for its services, and fees can fall as low as 0.03 cents to 0.82 cents per transaction. So Fedwire takes a variety of steps to manage credit risk and liquidity risk. So the receiving institution faces no credit risk as it receives central bank funds with immediate finality. The central bank faces both credit and liquidity risk to the degree they offer daylight credit overdraft during the day. This risk is mitigated by reviewing the bank's reserves, deposits, and with the Fed and post collateral. The Reserve Banks charge interest on their extension of credit that is calculated on a minute-by-minute basis. Deep stuff. So there are 3 types of settlement systems. One is the Fed ACH. So ACH stands for Automated Clearinghouse. You've probably heard of an ACH transfer if you've ever sent money bank to bank. So it's a payment network run by the NACHA, the National Automated Clearinghouse Association, and it's supervised by the Federal Reserve. So the Fed ACH is one of the two types of ACH providers that run over the National Automated Clearinghouse Association, and it processes about 60% of the ACH transactions in the United States. And ACH is used for high volume, lower value, lower time criticality transactions such as utility bills, payroll, business-to-business transfers, etc. And this processes about 60 million transactions per day. ACH transactions typically settle the next day, and they can take up to 3 days. But on the corporate and retail side, they're priced far less expensive. The fees aren't the same. So there's the other type, which is the CHIPS, the Clearinghouse Interbank Payment System. It's a private clearinghouse. It's for high-value transactions, and it competes with the FedWire. It's also a customer of the FedWire and uses it for central bank money settlements of outstanding balances at the end of the day. There's the Clearinghouse, ACH. It's a private ACH provider in the United States, and it's operated by the Clearinghouse that also operates CHIPS. Processes about 40% of all ACH transactions in the United States. There are some other major systems in the United Kingdom that they have in place, Europe, Eurozone, settlement and digital currencies that like this. So the question is Bitcoin an RTGS, or real-time gross settlement? So Bitcoin transactions, they're verified for the validity, and they propagate through the network's nodes in about 2 seconds. And they're not immediately reversible. And as they appear in more and more blocks every 10 minutes approximately, they become more irreversible, and they're considered confirmed within an hour. Can't go back and change that transaction after an hour. So transactions, they're not netted with others, but they're settled on an individual basis when transacting within the protocol. Not only that, but the inputs of a transaction must be the outputs of a previous transaction, meaning that there's no netting. Settlement on the blockchain is final and increasingly irrevocable the more blocks are added on the blockchain. So the more blocks added, like we said, about an hour, you're not able to go back and change those transactions. So if we assume it is an RTGS, real-time gross settlement system, the advantages for it is it's globally accessible, and any person on the planet without authorization, they can access it, versus with vetted financial institutions, whereas you have to go through rigorous systems to have in place in order to do so. It operates 24/7, 365 days out of the year. It keeps going. You can access it any time of the day, any day. This advantage will be somewhat slower settlement times, and the native currency unit is not widespread, real economically so far. But I think that's subject to change. We're still early on, and with the advancements at least I've seen in cryptocurrency from the few years, I haven't been in it as long as some people have been in it, but as long as I've been in this system and understanding cryptocurrency in general, the adoption of it hasn't even peaked yet. Like, we're still early. You're still early. Like, showing any type of interest in it right now, you're still early. If you're noticing they're integrating it into more and more of your everyday apps and systems, such as your social media, such as your Cash App, you're able to invest in Bitcoin. Like, the exposure is minimal, but it's there. They're giving you this minimal exposure because they're going to start increasing the amount of exposure you get exponentially. So, it's important. So, pay attention to it now. Financial services is a very developed industry with significant barriers to entry. So, hundreds of years of financial systems development, it's led to a very developed and sophisticated field, and it serves many needs. Most consumers in developed countries have a friendly consumer environment. Generally, taxpayer protection for deposits is 100K. Generally, consumer protection for misuse or fraudulent use of payment systems, and it makes use of financial system low risk for an individual user. Regulation and taxation is quite clear. Significant trust with financial institutions, and the costs well hidden from consumer and mutual laws. So fraud detection and customer reward costs, like airline points, are embedded in merchant processing fees and not directly seen by consumer, instead of entering the cost of products. I mean, there are a lot of benefits that come with having a central bank digital currency. But the thing is, the people who want that independence and freedom from these central systems and having to be regulated. And I mean, don't get me wrong, even if we do have a central bank digital currency, this doesn't mean that the other currencies will just fade away. They'll still be in system. They'll still have decentralized currencies at play. The thing is, I think because of the ease of having someone in control of your funds that people are used to, the people who aren't willing to do all the due diligence and the lifting that's required to carry around and be responsible for your own funds in that manner, that would be required from owning a digital wallet, it's going to attract, central bank digital currencies are going to attract a majority. The cryptocurrency industry is actually centered in the US and China. Some of the most people, it's crazy. Canada is a big one too. Let's see. And the cryptocurrency are actually most used in the US. 1975. Okay, boom, boom, boom. Let's see. So other things that are unproven but are still being worked on. I've had the pleasure of trying out a lot of these really cool stuff. If you're big into business, I recommend checking these out. Such as an ICO, which is an initial coin offering. It's similar to an IPO. It's like when a company hits the Nasdaq, or they hit the stock market to be exchanged, when they go public. There's STOs, securities, token offering. There's IEOs, initial exchange offering. So ICOs work from a technical perspective, but they did not work in practice from an investor protection perspective. Investors who actually bought in on a lot of these ICOs lost money because there wasn't always a guarantee. They saw the value and potential of investing in the coin, but the coin did not always take off and do as expected, so the returns weren't optimal. Some people were left holding the bag. Decentralized finance, that's a big one. It became really popular after the summer of 2020 with liquidity and volumes exploding. That was during the bull market run, but we're in a bear right now. The bears are where wealth is accrued. It has a lending and structured product market built on decentralized protocols where you can lend out money, you can borrow money, you can set up loans, all in the form of crypto. And there's insurance and prediction markets, so they're experiential right now, experimental right now. As always, you got to do your own diligence in this space. Our conclusion would be that central banks play a wide variety of roles in the modern economy, including monetary stability, financial stability, regulatory and policy operations, and financial infrastructure and provisioning. Some public cryptocurrencies provide a subset of the monetary policy and financial infrastructure functions of a modern central bank, but overall, they're much more laissez-faire. Laissez-faire, I hope I'm saying that right, political philosophy. And there has been a significant progress in CBDCs in the last 2 years, and we should expect CBDCs to start developing in the near future. And depending on the approach of CBDCs, whether they're direct, indirect, or hybrid, they might challenge the architecture and relationship with central and commercial banking. For settlement systems, all major currency zones have a central bank-backed real-time gross system, real-time gross settlement system. This serves as the backbone of the payment system, and it's both directly and indirectly. And despite the existence of these RTGSs, there are a variety of economic, liquidity, historical, and specialization reasons that other net settlement systems, payment systems exist, creating a heterogeneous payment and settlement environment. Bitcoin mostly resembles a real-time gross settlement system. It's unique. It's not the only one, but it's the one we use for reference. For financial services, as far as market opportunity related, they're complex. It's a large industry, very profitable. It's one of the largest in some countries, the most profitable industry in the world. Lending, investment banking, and most asset management and insurances still still don't have a viable cryptocurrency analog, and they're experimental at this point. But I would say it's lucrative if you know where to get in and how to get in. That's the thing with a lot of these currencies. Um, a lot of these systems and these infrastructures being built, just knowing where to get in and how to get in, and that makes all the difference. When to get in is one of the big ones too. But that will wrap it up. I'm thankful for everyone who joined in. We will have another class at 6 p.m. CST. I'm looking forward to seeing you all again. Great, of course. If you are on my other class, or anyone here as well, if you want to receive the packet that we're going over, if you're already in this class, you're going to be getting sent them via email. If you're on here and you want them, just let me know. I can send it your way for you to go